So how does private equity or private equity funds fit into an overall asset allocation or portfolio? Certainly, every investor or advisor is looking for an asset class or an investment that can achieve a better or the highest return with the lowest possible amount of risk exposure. And historically, private equity has been able to deliver that. But if you go back 15 or 20 years, private equity funds really were not accessible to accredited investors or qualified purchasers. They were really limited to institutional investors with minimum investments of 10 or 20 million. That's really changed, and even a lot of the leading fund managers like Blackstone or Carlyle or KKR are now lowering their minimums and making their funds available to qualified purchasers with minimums of 250,000 or sometimes $100,000 investments. And the case for private equity is really quite simple. And I'll start with this slide right here, which just shows that, let's say you're an investor and you're looking to invest in $100 million plus companies. Well, if you're in the United States, which is this left column, 87% of those types of businesses are actually privately held, and only 13% are publicly traded. So you're really only accessing about 13% of opportunities if you're just investing in publicly traded stocks. And if you look across the, at least in the two other major economic markets in Europe, numbers even greater. 95% of businesses over $100 million are private, 5% are public. And then Asia is fairly similar to the United States. So what's happened is that there's been a trend of businesses staying private for longer than they used to and going public much, much later, which means that more growth is happening in the private markets. And it's also worth mentioning that, taking a business public many times is the exit strategy of a private equity fund. By the time a business or a company gets listed on the exchange, they may have been through 10 to 15 different M&As, and private equity has increased EBITDA, has done the majority of the value add and growth, gotten the main growth phase out of the business. But when you look at like Amazon, for example, founded in 1994, they went public just a couple years later in 1997. So their private market return was a 10x. The vast majority has happened in the public markets. But as you move later in time and in more recent years, choose Facebook as an example, founded in 2004, they stayed private for about twice as long as Amazon. And the majority of growth happened in the private markets through in private equity. And the public market return has been 9x. Alibaba, even more so, stayed private longer, less growth in the public market, more growth in the private market. But this is a trend happening across the board. So when you look at the number of US listed companies, that number is going down, which means that more businesses are staying private, presenting a significant opportunity in the private sector. And also the average size and age of business at IPO is increasing, which means that more growth is happening in the private markets, and it's causing a greater size and greater valuation once they do actually get publicly listed. So what's the attraction of private equity? And this pretty much sums it up. So the average return of private equity is about 12% historically, going back to the mid-90s. This shows through 2016, so there's 2 decades, but the numbers have remained the same up to now, 2022. And the S&P 500 average return we know is about 8%. So you're talking about an almost 50% greater return in the long term. And more importantly, I mentioned at the beginning, we want the best possible return with the lowest amount of risk exposure. So the primary measurement of that is standard deviation, and the S&P has a 17.2, and the private equity index as a whole has 14.5. So we have higher return, lower volatility, which of course is what everyone is looking for. Now there's of course some trade-offs to that. One of them is the barriers to entry, which can still be high for probably your average investor, typically not a problem for a qualified purchaser. And two is, of course, liquidity, which each fund kind of has its own liquidity parameters, but generally much less liquid, of course, than being able to just go into the open market and click a button and sell a stock. So these are those same numbers. This is the this kind of evergreen color here is the Cambridge Associates Private Equity Index. It's really just a grouping of all the private equity funds. And you can see that pretty similar number to that previous slide. So 4.7% per year in overperformance versus the S&P 500. But also interesting considering the time that we're in right now with a possible recession, just a lot of uncertainty in the overall economy and specifically in the public markets. What we typically see is that private equity outperforms by a wider margin when the returns of the public markets aren't so great. So here on the right, we see when the public market has a 3-year annualized return of higher than 15%. We still see private equity historically outperform, but only about by 1.5 points. But when the public market is having a more average type return, let's say between 5 and 10%, we see a much wider margin. Private equity outperforms by almost 8%. And the same thing when the public markets are down. So a return less than 5%, we see outperformance by almost 8%. And that certainly showed in 2022. The majority of private equity funds, at least the ones that we use, were in positive territory. And some 8, 9, 11% return for 2022. So this slide really kind of sums everything up when we're talking about risk versus return of private equity. This lays out several of the major asset classes. Of course, we have private real estate over here. So the standard deviation quite low, so low risk level, and a return of about 8%. Where let's go over to, let's say, large cap equities, for example, which is going to be like your Dow stocks or S&P 500 stocks. You have a much higher standard deviation. Here's that around a 17 and a much better return. Makes sense, right? But private equity is attractive for investors who don't need liquidity because higher return than the equity markets, which we discussed on some previous slides, and also a lower standard deviation. So certainly there is a role for private equity funds for the right client who's looking for growth, not income, who's willing to sacrifice some liquidity. So if you'd like to understand more about some of these specific private equity funds that we're using, whether it's Blackstone's new fund or Apollo or CNL or KKR, Crescent Partners has some great private equity funds. Certainly, you're more than welcome to reach out to me. My name is Andrew from Jesani Wealth Management, and you can reach us at 954-800-8552. I hope that this was helpful. Thank you.